Right now, the United States is estimated to be short more than 4 million homes. That number comes from National Housing Supply Gap research comparing household formation to construction over the past decade. 4 million. And yet, headlines keep talking about oversupply in certain markets. So which is it? Too much supply or not enough? Let's unpack what this shortage actually means and what it does not mean. Before we do, I'm Corey Bonner, owner of one of the fastest growing property management companies in the country focused in the Boise, Utah, and Phoenix markets. If you give me a like, well, let's just say I'll keep bringing this beard back with more information you need to maximize your ROI in your investing and developments. And if you appreciate long-term data over short-term noise, make sure you subscribe. We're going to keep zooming out and looking at structure, not just cycles. Section 1, where the 4 million number comes from. According to Realtor.com's recent housing supply gap analysis, the United States underbuilt housing by millions of units over the last decade relative to population growth and household formation. Census data shows that new construction never fully recovered to historical replacement levels following the 2008 housing crash. From 2009 through much of the 2010s, housing starts remained well below long-term averages. At the same time, housing household formations resumed. That gap compounded year over year. That is how you get structural shortage estimates above 4 million homes. This is not a one-year imbalance. This is decades long of underproduction issues. Section 2, why it does not feel like a shortage everywhere. Now, here's where the nuisance matters. A national shortage does not prevent local oversupply. Certain metros built aggressively during the recent boom. Census housing starts data shows some of the Sunbelt regions dramatically increased supply over the last few years. When supply spikes locally, even within a national shortage, you get temporary softness. That is what we are seeing in parts of the country right now. National shortage, local adjustments. Those two can coexist. Let's get into Section 3. What this means for long-term pricing. When a country underbuilds for decades, supply elasticity shrinks. That means when demand returns, price responds faster. We saw this during the low rate surge from 2020 to 2021. Inventory was thin. Demand accelerated. Prices moved quickly. The structural shortage amplified demand shifts. That does not mean price only goes up. It means volatility increases when demand changes. Long-term chronic underbuilding supports baseline priced strength. Short-term local oversupply creates negotiation windows. Understanding both is critical. Section 4, what this means for developers. For developers, the 4 million unit shortage is not permission to build blindly. It is a context here. Yes, there is structural need, but supply must match local demand drivers. Now, this has job growth, population growth, income levels. Permit data matters. If you build in markets where household formation is outpacing construction, absorption improves faster. If you build in markets where supply recently surged ahead of demand, you face longer stabilization periods. National shortage does not override local math. Disciplined developers align structural trends with local data. Section 5, what this means for small investors. Now, for small investors, this shortage helps explain why rents and home prices did not collapse despite rate increases. Census rental vacancy rates remain below long-term crisis peaks. Supply constraints create floor support. But again, local matters. Watch your metro. If construction slowed meaningfully in your region over the last 12 to 18 months, future rental supply may tighten. If permits remain elevated, competition persits longer. Structural shortage provides long-term support. Operational discipline determines short-term performance. Before I continue, if you're a developer or investor trying to navigate both short-term cycles and long-term structural trends, I put together a study that walks through how disciplined operations protect performance across both environments. You can grab that at corybonner.com/case study. Strong projections are built to survive cycles, not depend on perfect timing. Now let's close this out. Section 6, what to watch next. If you want to understand how the structural shortage evolves, watch census housing start data, building permit issuance in your metro, household formation rates, net migration trends. If starts continue moderating while household formation remains steady, the structural shortage persists. If starts accelerate dramatically nationwide and sustain for years, the gap narrows. These are slow-moving structural metrics. They matter more than monthly sentiment swings. So in closing, America being short 4 million homes does not mean every deal works. It does not mean every market rises. It means long-term supply discipline matters. It means real estate remains a fundamental-driven asset class. And it means operators who understand both structural and cycle outperform those who chase headlines. What you're seeing in your region is a supply slowing. Are permits dropping or are builders still active? Drop your perspective below. If I miss something in your local data, I want to hear it. And if this kind of structural breakdown is helpful, make sure you subscribe. We're going to keep separating signal from noise.